The old floor traders used to say, when the VIX is high, time to buy. When the VIX is low, look out below. The CBOE Volatility Index is nicknamed the fear index of the stock market. But why? Give me a like and a follow, and we'll get right into it. Basically, the VIX measures how much traders expect the market, specifically the S&P 500, to move over the next 30 days. The VIX is calculated using SPX options pricing, both calls and puts, on the S&P 500. It uses a wide range of the out-of-the-money options. So when traders are buying a lot of options, especially puts, the VIX rises because the pricing has to meet demand. And when options are cheap and there's low demand, the VIX falls. It reflects the expected or implied volatility, but not the direction necessarily, which can get confusing, but we'll talk about that. So the VIX measures the implied volatility, which is what traders expect, but not the realized volatility, which is what actually happens. That's why the VIX can be high and the market still rallies, and the VIX can be low right before a sudden move. And there are a lot of nuances, so that's what we're going to get into here. Here's a simple way to think about the value of the VIX. So let's look at a VIX chart to get an idea of how it moves. When the VIX is low in the 10 to 15 range, the market is extra calm and we have small expected moves. In a normal or medium VIX, it'll be generally around 15 to 25, where we have a normal volatility range. And a high VIX of 20 to 40 or even more means that we should be watching out for some really large expected moves because there's a lot of fear and uncertainty. It can spike a lot higher than 40. It can go to 60 or more. So let's talk about what the VIX number actually is. And the VIX number is the percentage of the expected annualized or annual volatility or move. So if the VIX is 20, we have a 20% annualized volatility, which means that if the current conditions causing the VIX to be 20 kept happening for a full year, the S&P 500 would be expected to move about 20% from where it is over the course of that year, although that doesn't tell us the direction. So I want to clarify here, I mentioned the VIX is based on the 30 days of options prices and not the full year. So let's talk about that. The VIX is based on 30-day options pricing, but it's expressed in annualized terms for standardization. So the 30-day expectation calculated from the current S&P 500 options market is converted into a yearly percentage output. So if we want to translate that into a daily expected move, there is an equation to convert that annualized volatility of the VIX value into a daily expected movement. And the way we do that is we take the VIX and we divide it by the square root of the average number of trading days in a year, which is 252. So with a VIX of 20, the square root of 252 is 15.87. 20 divided by 15.87 is about 1.26% per day of expected move. Traders simplify that for quick and easy math and use 16, which would then come out to 1.25%. That's why the expected move in points or dollars varies over time, even though the VIX has relatively equal peaks and valleys. The same 1.26% move is a lot different with the S&P at 7,000 than it was when it was at 3,000 not that long ago. Day traders care about the VIX because volatility equals opportunity. If we think about the VIX as the expected move, it makes sense that a high VIX leads to bigger movements and more potential profit and risk. So that's why we size down and move our stops out. where a low VIX is going to mean that we have a slower, choppier market, and it might be harder to hit those targets. So this can help traders with position sizing because high VIX means you can allow those wider stops, but you're going to have to take a smaller size. A lot of us have been through this before where the market has expanded and suddenly all our stops are getting hit and we have to reevaluate everything. If we have a low VIX, that tighter structure with anything that's not expecting those big breaks tends to work better, and we can size a little bit heavier and go for less of a move. When we're looking at setups, this can also help because with a high VIX, expansion is more likely, so that can help our breakout plays. But if we have a low VIX, we're going to be more prone to chop and fake outs, but there's more rejections and potential ranges to play. A couple of other important things to note about the VIX is VIX has some behaviors that are a lot different from the stocks and the other indexes. So the VIX is mean reverting. So that's why all of these spikes tend to fade over time. VIX rises fast, hitting these peaks, and then it falls a little bit more slowly. And that's because fear is reactive and calm is not, and we tend to return to it more gradual. That should also make sense with everything else that I've told you on other lessons about how the psychology of fear being such a strong force affects both our own mental game in trading as well as the greater market moves. And another broken record point that I tend to make is that the broader market context always really matters. So that normal VIX range of 15 to 25, when we think about what's going on in the actual world around us, it can really help it make sense. Because in a normal, slow bull market that's grinding higher, the VIX might hang out around 12 to 18, but in a more volatile, uncertain, but still within that normal range market, normal might shift up to that higher 18 to 25 side of normal. That context always really matters. Also, you probably could see this already, but VIX has a reverse correlation with the market, meaning in general, it's going to move in the opposite direction. It's not perfectly inverse, and there can be divergences, but in general, it's going to be moving the opposite direction with that reverse correlation. But you can have the market grinding higher with VIX up because the big guys are hedging into strength. And a lot of times that can kind of look like absorption. Or the market can be melting lower with the VIX kind of staying flat when that heavy selling is actually really controlled. But in general, the VIX moves opposite the market because if the market drops, traders are looking to buy protection for their holdings and those long positions by buying puts. And this causes the implied volatility to rise, so the VIX rises. And then if the market is rising, there's less demand for that protection, so the implied volatility falls and the VIX falls. It's reacting to how aggressively options are being repriced by the aggression and the demand in the options market. So you can have price going down with a small VIX move because the market is making a really controlled move, or you can have price down plus a big VIX spike because there's a lot of panic and instability in the market. So when VIX is high, like 25 or higher, the large moves are already expected in the market. And when VIX is falling from 25 to 30 or something like that intraday, what we're seeing is that volatility being unwound because traders are closing hedges and selling volatility. So when we see a falling VIX, that means that we're seeing volatility compression. What that means is we can expect level breaks to be more likely to follow through to targets. And if support breaks, continuation is more likely. But if support holds, the reversals can be really sharp and powerful. So basically, we can expect large moves and not chop, and we shouldn't assume that any support will hold. But if we have a low VIX and prices coming down to support, we probably have a calm environment with not a lot of urgency. So we can expect support to be more likely to hold and price movements to be slow and more contained. So the mean reversion type of strategies are more likely than the expansion breakout strategies at key levels when the VIX is low. On the other hand, if we have a high VIX and we're up at resistance, breakouts can run hard and rejections can drop really quickly, elevator down kind of stuff. With a high VIX, whichever side wins tends to move farther and go harder. So for trend or momentum confirmation, if the market is down and the VIX is rising, we have confirmation of downside pressure and the higher probability of continuation. But if the market is down and the VIX is not rising, it's more likely to be a weak move or a divergence, and that makes it more likely to be a controlled corrective move than a big violent one. But if the market is up and the VIX is falling, we are a lot more likely to have a healthy trend, and VIX should be moving lower because the hedging is being removed. So that makes a lot of sense. But if the market is up and the VIX is rising, we have a divergence and some potential instability, kind of a setup for a late stage move potentially, but there should be a lot of warning in that. So if we want to look at the VIX to see if we're more likely to have breakout versus range conditions, a high VIX environment means that larger moves are expected, so breakouts are more likely to expand and ranges can break more decisively. It can be a little bit more unstable too, though. That's why some traders don't like it. A low VIX environment means that small moves are expected, so we're more likely to have the range-bound conditions. Breakouts are more likely to fail, and the market's not going to have as much follow-through. It'll be a lot more limited. The range traders like this environment, the breakout traders don't. If you're wondering about trading the VIX, you can't trade the VIX directly because it's an index, but you can trade VIX futures and the VIX ETFs, which track the futures and not the spot VIX, by the way. But okay, so this might be a little bit more advanced, but I think this is important and not a lot of people teach this, and that is term structure. So VIX has a futures curve, which is also known as term structure. So that tracks the expected volatility across multiple future expirations, which means front month, second month, third month, and so on. And these are VIX futures contracts, not options, that each represent the market's expectation of the volatility or the VIX at that specific future expiration date. The most important for the VIX is the front month, which has the nearest expiration. That'd be the one that's currently going on. And it reflects the immediate, most current volatility expectations. And then there's the second month and beyond. And what those are going to show us is the future expectation of volatility. And traders can watch the spread or the difference between what the value is between the front month and the second month in futures. And that'll give you a quick gauge of what's going on in the market, how stressed it is. So when we're at Contango, that's when the future VIX expectations are greater than the current VIX expectations, the front month. So that means that the longer dated contracts, the ones farther in the future, are priced higher than the current nearest term contracts. And when this happens, we tend to have a more normal, calm market. But if we're in the opposite, we're in backwardation, which means the current front month VIX is greater than the future VIX expectations, meaning the near-term contracts are priced higher than the later dated future ones. And that means that the market is seeing some short-term stress and maybe some elevated near-term risk, but the expectation is that it is going to calm down over the coming months. So using that term structure, we can confirm whether the volatility is temporary in backwardation with short-term stress, or if it's more normal in contango with no immediate stress, but a little bit of fear in the future. So to clarify, the CBOE volatility index itself is derived from the 30-day options, but the term structure that we were just talking about with contango and backwardation, and that one comes from the VIX futures, and those extend so that we can see what those expectations can be at future dates in the futures. So you're comparing the right now volatility with the VIX in the front month versus the future volatility expectations with the later month futures. So another way to put that, if that's still confusing, is that if the near-term volatility is higher than the futures, then the market is more stressed right now, but expects the things to return more to normal in the horizon. And if the future volatility is higher than now, the market is calm now, but expects some uncertainty later. VIX is also related to Gamma, so we'll brush on that as well. But in options, we have delta, which is the directional exposure, how much an options premium changes for each dollar move with the underlying, like the S&P 500 ETF, or the gamma, which is how much that delta changes for each dollar move. So that delta is it's a number that can change over time according to the gamma. So gamma tells the dealers how much to adjust their hedges as the price moves. And this has to happen because the market makers or the dealers are usually on the opposite side of trades, including the options trades, because if a trader buys options from the dealer is now short those options. And if a trader sells options, then the dealer is now long. And that can put them in an awkward situation. So dealers hedge those option predicaments using the futures like the ES or the NQ. And gamma effects are the strongest near where those option positions are at those key strikes. And that's why price can pin to levels or can really accelerate when it breaks through those levels. Those are gamma levels associated with hedging in the options market, and they're very related to VIX. So if you have negative gamma going on, the dealers amplify moves and buy as price rises and sell as price falls, and that gives us expansion. And if we're in negative gamma, the dealers dampen the moves and sell as price rises and buy as price falls. So we wind up in chop. So basically, the gamma tells us how price reacts after it moves, and the VIX tells us how large the move may be. So together, they're going to answer the question, will the move stall or accelerate? VIX tells you the size of the move, and gamma tells you if the move is going to stick. If that helped, you know the drill. I have other lessons in the works and already posted, and there's also a growing library of information, data, and tools at bullbarbie.com, and maybe even a link to connect with me in trading chat. So see you there soon. Love you. Bye.